Hello, everyone, and thank you for joining us today. I'm Alex Ackerman, one of the leaders of Marsh's private equity and M&A practice here in North America. Thank you for joining and welcome to our webcast, Trade Credit and Liquidity Strategies for Private Equity, featuring Dan North, the Chief Economist for Euler Hermes in North America. I'd like to remind everyone that you can ask questions at any time by clicking on the Q&A icon in your Zoom menu on your screen. Simply type your question in the open area and click Submit. We'll try to devote as much of our program to answering your questions as possible. Also, if we don't get to your question today, someone will get back to you after the discussion. You can also email any questions about today's presentation to questions@marsh.com or reach out to your Marsh representative. We'll be sending everyone a replay of the discussion approximately 48 hours after the wrap up today. Before we start, I'd like to introduce our speakers. We are joined today by Michael Kornblau, Managing Director, U.S. Credit Specialties at Marsh, Brandon Baker, Vice President, Marsh Credit Specialties, Mike Treleaven, Vice President, Marsh Credit Specialties, and Dan North, Chief Economist at Euler Hermes. As we think about the applicability of trade credit as a solution or tool to improve liquidity in the current environment, a few key themes drive the discussion. Private equity is involved in intense competition with thousands of other firms with billions to spend on the relatively small pool of companies available for sale. Private equity funds and their portfolio companies are competing consistently with strategic investors who are already established in a particular industry who may already have trade credit platforms from which to drive value. Because of these realities and general ROI expectations of investors, it's extremely important for private equity buyers to get their portfolio companies operating at a profit as soon as possible and to establish their own credit facilities with financial institutions to avoid further possible post-acquisition capital injections. At the same time, maximizing borrowing availability and managing liquidity is a top priority. COVID-19 is slowing revenues substantially for many companies and therefore negatively impacting cash flow. And many are also experiencing a slowing of payments from customers and even defaults. These factors are further compounding the liquidity challenge many of you may be facing. Trade credit insurance is commonly utilized by private equity-owned companies to maximize borrowing availability and/or sell accounts receivable, improve cash flow and liquidity, protect the balance sheet against unforeseen credit losses, and drive organic revenue growth and profits. I'd like to introduce Michael Kornblau to briefly discuss the COVID-19 impacts to the trade credit and finance markets and introduce our guest speaker, Dan North.
Thank you, Alex. Good morning, everyone, and thank you for making the time. So obviously, the impact of COVID-19 has been widespread across our markets, and it's been hugely impactful. And what we want to talk today to you about is the product. And the overall trade credit product does respond to this type of loss and the impacts of COVID-19. COVID-19, while not itself a named peril, it does get covered through these policies through the comprehensive nature of the credit product, which Brandon and Michael will discuss later. Really what's happening in reality is companies are facing diminishing revenues, diminishing profits, and difficulty in collecting their accounts receivable, which is impacting their working capital throughout the entire supply chain. These liquidity shortfalls can trigger loan covenant breaches with the banks and ultimately cause the banks to reduce or not be able to provide enough credit cover for their customers. And this is putting solvency at risk for many companies. The credit downgrades and deteriorations can make accessing cash flow a big challenge, and we're certainly seeing banks putting up more restrictions across the renewals and the existing facilities as well through this increased scrutiny. Now, except for some of the government-backed schemes that we all know about, banks have certainly become much more restrictive on how they're looking at these new facilities. This is also coupled with the fact that prior to COVID-19, as Dan will explain later, we already were witnessing higher insolvencies and more trade credit losses throughout the market. So where we are at now is that on the back of the environment before, and certainly now with COVID affecting the markets, appetite has certainly tightened across the entire trade credit landscape. We're seeing premiums increase in more restrictive underwriting, particularly in certain sectors. So as we look through to this, access to working capital is really the primary line of defense that many companies are looking at to weather this COVID-19 storm. So solutions do remain available, and we'll talk a little bit more about some of these financing solutions that use insurance to provide more working capital for customers to weather this storm. So with that, I would like to introduce Dan North, who's the chief economist at Euler Hermes North America. So Dan North has been with Euler since 1996 and has been using macroeconomic and quantitative analysis to help manage Euler's risk portfolio, which is about $150 billion across the US. As an economist, he has appeared on CNBC, Fox Business News, France 24, The Street, Bloomberg Radio, and television. He has been quoted by Barron's, Business Week, Paris Le Monde, Tokyo Nikkei, and BBC, New York Times, and Wall Street Journal. After having predicted the 2008-2009 recession and the implications accurately, he was ranked 4th on Bloomberg's list of the top 65 top economic forecasters in 2010. Dan is a graduate from the Wharton School of Business. And without further ado, I'll turn it over to you, Dan.
Sorry, guys. Been having a little trouble with the mute there, and I think I can be heard now. Michael, thank you very much for that kind introduction, and thank you to all for tuning in this morning. I certainly appreciate the opportunity to speak to you. Obviously, my colleague is going to be talking about trade credit and liquidity, but I did want to spend just a minute to tell you who we are. Euler Hermes is the world's largest provider of trade credit insurance. We have been around for we've been around for 125 years. We have a AA rating from S&P. We have offices in 52 countries around the world. We're owned by the Allianz Group. We have 6,000 employees and 52,000 clients worldwide. And we do insure $150 billion in US sales and over $1 trillion globally. And we pay 85,000 claims per year. Now, the protection against non-payment is primary benefit of our trade credit insurance policy, but a lot of our clients use us for sales growth, because if you want to sell to someone you don't know about or sell into a market you don't know about, we probably do know about them because we have an international risk database of over 85 million companies worldwide. I do want to start off by talking about COVID-19. COVID-19 is really driving the entire economic landscape right now. Now, the next slide I'm going to show you, I've been showing for some time because it's actually been pretty hopeful, but I'm afraid it's not anymore. This is the statistics from last night. This is daily new confirmed deaths. And you can see across the top there, that red line is the United States. Well, it used to be flat a little while ago, but now it's clearly turning up. And of course, Brazil is sort of a bad situation as well. They have more cases now than the US. And you can see India and Mexico, one of our largest trading partners, going up. So this is all a little bit unsettling. Most of the European countries are already on the way down. And to look at it a little bit more detail, we see this chart over on the left, broken out by regions. Sorry, we're having a little bit of delay here in the control. There we go. Broken out by regions. So over on, gosh, sorry about this, guys. The control is delayed and is going back and forth on me. So on the left there is COVID cases by region, and you can see in the Northeast and the Midwest, they're going down, but in the South there, where you have Florida and Georgia and Texas, they're clearly on the way up. And so in the West as well, Arizona and California on the way up. And the chart on the right strips out the tri-state area of New York, New Jersey, and Connecticut. And that shows it's even worse. That's that pale blue line going up to the right there. So unfortunately, the COVID statistics, which were getting better, now I'm afraid are going the other way. Now, let's look at the response to COVID. And, you know, our forecast actually is for a U-shaped recovery. That's over there on the left. That's GDP growth, gross domestic product. It's our broadest measure of the health of the U.S. economy. And you can see here, this is the Great Recession. And it looks, you know, compared to what we're going through now, looks almost quaint. So we're forecasting in the second quarter of this year that GDP growth is going to be down by somewhere around 30%, maybe even 40% at this point. But we do see that we're going to have a recovery in the third and fourth quarter, a good rebound. So in theory, this actually should be pretty easy to accomplish because we put ourselves in the recession by shutting everything down. And we've also got fiscal and monetary support to help tide us over. And now it should be a matter of just turning the lights back on, you know, opening things back up, right? Well, sort of, but it's not quite that simple. There are some impediments to this recovery. And it's important to understand how we got here, to go back and look at how we got here. So even before, so this is our forecast on this page, but let's look back a little bit in time. Even before COVID came along, the economy actually was pretty fragile. So for instance, over on the left is the index of leading economic indicators. That blue line is the lowest since before the Great Recession, indicating, you know, conditions 6 to 9 months forward, very weak. The middle chart shows that manufacturing was clearly in recession. This brown line, durable goods orders, you know, falling at 14% year over year. And over on the right is the consumer confidence survey. And basically what this shows is, it's the blue line, is the difference between how consumers feel in the future and how they feel now. In other words, when the blue line goes negative like that, it means that people are really concerned about the future, and they're usually right, because you see every time that blue line dips below zero, it's associated with a recession. That's those gray columns there. So we had a number of things that were showing evidence of really were rather fragile. And then remember, we were in a trade war. Well, no, you probably don't, but that was the biggest thing before COVID came along, was a trade war. And guess what? We're still in the trade war, I'm afraid. Now, so we knew that it was very, you know, it was a fragile situation. And most economic data comes out, you know, it comes out once a month and it comes out with a lag. But we knew that there was one thing that comes out a little bit more frequently, which is called weekly jobless claims. Now, weekly jobless claims basically is a matter of people going into their unemployment office and saying, you know, the company I worked for, the building burned down, or I just got laid off, or something along those lines. This is a 50-year chart, and it shows on average over the past 50 years, about 350,000 people would go into the unemployment office every day, every week, very common. This is a 50-year chart. I'm going to show you 50 years and 1 week, which was the week in March where we really started to shut things down. And to do that, I have to totally redraw the scale. So you can see that 50-year chart was compressed down to this thick blue line. And here we are on March 21st. We didn't get 350,000 claims. We didn't get 700,000 claims or a million claims. We got 3.2 million jobless claims, about 9 times the long-term average. So as I say across the top, this isn't unprecedented. It's something completely different, really. Now, another way to look at it is to go back and look at all the jobs we created during the recovery at the end of the Great Recession. So after the Great Recession ended, if you follow this blue line, this is the number of jobs we created. We created 5, 10, 15, and in 10 years after the Great Recession, we created 23 million jobs, and they were all gone in 5 weeks. 10 years worth of job growth wiped out in 5 weeks. Now, the good news is the weekly jobless claims chart is shown in the middle there with the most recent data points. Here's that average of 350,000. Here's this enormous increase. And now you can see it's starting to slow down. It's slowing down to an astronomical level, but it's starting to slow down. Now, this is the number of people that came in the office that week. The chart on the right is what we call continuing claims. That's the number of people who are actually still on the unemployment benefits rolls. And that has come down, not as much as we would like, but it does suggest that people, in fact, are going to work. So you could look at these charts and go, you know, maybe we are bottoming out. In fact, there is some pretty good evidence. We have some other good indicators that, in fact, we are bottoming out. For instance, the chart on the left is jobs created by month. The jobless claims were just claims for jobs that had been extinguished. This chart shows the net jobs created. Now, you see there in March, we lost 1.4 million jobs. That was a record until we got to April, where we lost 21 million jobs. April was the month where the country was basically the whole month was shut down. Here's the previous record back at the end of World War II, where industrial production ended. That's the previous record. I mean, you can hardly see it compared to the red lines. But we had this basically heroic comeback in May, 2.5 million jobs, and that was more than twice as big as the previous record. So we had this devastating fall in jobs, but a heroic comeback. You can see the same thing on the right. Retail sales made a fierce comeback. You know, we lost 15% virtually in April, but then we made this huge comeback of almost 18% in May, where the previous record had been 6.7%. This is really strong evidence of a bottoming in the economy. However, it doesn't mean we're bottoming, but it doesn't mean that things are good. And that's what this chart shows. So at bottom might imply that we're at the end of the recession. In fact, the people that declared recession said we would end recession in February. They're probably going to say we went out of recession in May or June. And that's great that we're out of a recession. But when we mean that we're ending, the end of the recession means things have stopped getting worse. That's all it means. It doesn't mean things are good. They're still bad, and we have a long way to go. And conceptually, this chart shows economic activity, recession, economic activity starts to fall, and then it bottoms out at the end of the recession. Things have stopped receding, and that's where we are now. You know, an analogy about a recession would be, think of it as a tide. You know, the economy is a tide, and when it starts to go out, the tide is receding. And when it stops receding, the recession's over, but it's still a long way from where it was. It's got a long way to come back up the beach. And that's the question we've got to face now. This is really the most important question. We know we've bottomed out for all practical purposes. How long is it going to take our economy to get back to where we were? Well, we can go back and look at previous recessions and see how long it took to get the jobs back in previous recession. Now, this chart shows each line is a recession, and each line shows the number of jobs cumulatively lost or gained during that recession. So, for instance, the black line is the 1980 recession. And if you follow it down, you can see where we lost something like 1 million jobs in the 1980 recession. But then it came back. We recovered them all. We came back to zero in something like 12-ish months. So we lost 1 million jobs and got them all back. Now you can see the worst one of all was, of course, the Great Recession of 2008, where we lost 9 million jobs, and it took us about 6 years to get them all back. And I want you to notice the shape of those curves, because it's very conceptually like the curve I had before. You bottom out here, and then it takes a while to get back. So this is what's happened in previous recessions. And to show you where we are now, again, this is a case where I had to redraw the scale. That red line is the situation where we are now. I mean, it's, again, it's not an unprecedented matter. It's something that's totally different to all the other recessions. Now, it looks like we've had a bounce back in May. In fact, we did. And it seems like it's a good start, but there's a really long way to go. And here's how I would guess how long it's going to take. And again, it's just looking at this data on this chart in a numerical fashion. So for instance, the table shows that in the 1974 recession, it took us 20 months to recover the jobs. In the 1980 recession, well, it only took 11 months, so forth, all the way down to, again, that Great Recession where it took 77 months or 6 years to recover all those jobs. And in the modern times here, the average is 36 months, 3 years. Well, that's 3 years, but there was this extraordinarily long period. Let's take that out and say that's an aberration. Well, we're down to 28 months. So by the historical record, it's going to take somewhere between 2 and 3 years to get all the jobs back. And my guess is it's been such a severe drop that it's going to be more like 3 years, and we're going to be looking at 2023 before we get all the jobs back. Now, there's another measure of the economy is gross domestic product. Let's see how long it takes us to get back to gross domestic product. That is basically the level economic activity. This is the number of months here on average, about 19 months. Strip out that very long period, it's about 17 months. Let's call it a year and a half. I think we're looking at 2022 before we get back to that level of economic activity that we had before. So we've got a little ways to go. Now, let's stop and recap here for a second, see where we are. Even before COVID-19 came along, the economy was fragile, and then the response to COVID-19 just devastated the economy. We had huge drop-offs in jobs and consumption. A lot of damage that was as bad, if not worse, than in the Great Depression. The Great Depression, not recession. But now it looks like that data has bottomed, but that does not mean things are good. They have just stopped getting worse. That's what the end of a recession means. Doesn't mean things are good. They've just stopped getting worse. And now the question is, how long is it going to take for us to get back to where we were? You know, an example might be those restaurants that had to close or shut down completely, and now they're back up at, let's say, 50% capacity, and it maybe will take a while to get all the customers coming back. You know, think of that as an example. Well, it's going to take a couple, 2 or 3 years to get all those jobs and that economic activity back. Let's take a look for a minute at some of the headwinds and tailwinds to this recovery. So we can see that consumers on the left, consumers resume spending, but you got to have income to spend. And that's over the chart over there on the left. You see that big spike, April, 13%? Well, that was because of the CARES Act, you know, those $1,200 checks that were sent directly to people, and, you know, the $500 per kid, and those extended unemployment benefits. So, you know, people became unemployed, but the CARES Act covered them. And so there was this big spike in income. Problem is, the chart over on the right, that spike in income is going to collapse in the next couple of months. So those are those red columns there showing that that big boost in income from, for instance, those direct payments, well, unless something happens, those are not scheduled to be renewed. And then in the end of July, those extra unemployment benefits, they're going to drop off as well. So you got this big boost in income from CARES and so forth, and that income's about to fall off a cliff. So that is certainly an impediment. That's the consumer side. Let's look at the corporate side. You know, this corporate side has not bottomed out. So here are corporate profits on the left. You see that red column there? Corporate profits, that's the first quarter. So we still have a ways to go before corporate profits bottom out. I think the next quarter is going to be even worse. In the meantime, we've got a corporate debt situation that's really quite worrisome. In the upper right there, you can see we've got a record high corporate bond defaults in just the second quarter. The US is the blue part, the red is the rest of the world, and that's surely to go up next quarter. And then in the bottom right is the share of zombie firms. Now, zombie firm basically means these are companies that have borrowed a lot of money and they can only cover their interest expense. And in many cases, they may not be able to cover their interest expense. They can't pay down their debt. Because they can't pay down their debt and they spend everything covering their interest, they can't do anything. They have no room to grow, no room to invest. So they're just zombies moving along, trying to cover their interest expense. And of course, this is going to increase business bankruptcies. So we see from the consumer side and the business side problems coming. And that's what we see here in this chart. Over on the left, on the consumer side, these are delinquencies greater than 90 days in terms of billions of dollars. Well, you can see the red line is auto delinquencies clearly on the way up. Green line, credit delinquencies on the way up. Student debt, the pale purple line, obviously the biggest part of consumer debt on the way up, and even mortgages to a slighter extent. So that's the consumer side. On the right, which is maybe more relevant, is business bankruptcy filings. Now, you can see that during the Great Recession here, the business bankruptcy filings soared, but they've fallen ever since the Great Recession. Not anymore. We think 2020 business bankruptcy filings are going to rise 25%. We really think that conditions are bad enough that we're going to get an increase of 25%. Now, look at these two examples where I've got this red circle, and it refers to this text. In 2006, there was a change to the bankruptcy laws that became more creditor friendly. So if you were a company on the brink in 2005 and you knew the laws were going to change where you were going to get treated more harshly, it led to a surge in bankruptcies in 2005. That's one of the things that's happening now, and it's going to happen this year. And the reason is there is a subchapter 5 of the Chapter 11 Bankruptcy Code that is going to, a threshold is going to expire by the end of this year. Basically, it means laws are going to change to make the bankruptcy code less debtor friendly, more creditor friendly. So if you're on the brink, if you're a debtor on the brink, and you know those laws are going to change in favor of the creditors, you're going to rush to bankruptcy. And that's what we're going to see. Here's another problem that we see in the economy. You know, I was talking about those unemployment benefits. Those are a problem, and here's why. Now, this chart, each line, each horizontal line is a different state. And each line shows the percentage of wages that are replaced by unemployment benefits. So this top state is Maine. Over on the left, these gray dots show how much your wages are covered. So in Maine, you know, something like 45% of wages were covered by unemployment benefits. You used to make $100, you apply for unemployment, you get $45. Well, with the CARES Act, those unemployment benefits have been jacked up $600 a week nationwide. And that drives this pale dot all the way over to here, the green dot, where now in Maine, you're making $130 a week instead of the 100 you were usually making a week. In other words, in Maine, you're getting paid more to stay home. And that is the case in 37 states. And that will be the case in 37 states through the end of July. So this is clearly an impediment. We're not going to get employees back as quickly as we thought. It pays more to stay home. At the same time, we're not going to get consumers coming back as soon as we thought. This chart is a survey showing the percentage of adults who said they're currently comfortable doing the following. And the dark dot is the most recent survey. Well, are you comfortable going out to eat? 40% of adults say yes. That's less than half. I mean, 40% sounds like a lot. It's less than half. How about going on a vacation? 35% say, yeah, sure, we're comfortable. It means 2/3 are not. So consumers are not going to be coming back as rapidly as we hoped as well. So we've got bankruptcies increasing and unemployment benefits holding us back, income cliff, and consumers not coming back. So these are the headwinds. But it isn't hopeless because there's some other things going for us as well. So for instance, on the left is an indicator of the housing markets. This is an index of applications for mortgages for purchases. Each line is a different year going out throughout the year. And the blue line is 2020. So clearly at this point in time, demand for mortgages is greater than it's been in the last 10 years. And we see some other signs in the housing market that show that the housing market is likely to have a strong rebound. In the middle, you can see the change in local businesses opening up. And over on the right are credit card transactions. You know, the grouping of columns on the left is the number of transactions. On the right is the dollar of sales. And what the chart means, that is in the most recent survey week, credit card transactions were up 20.8% versus March. March, they were, let's say, at 100%. Now they're up 20.8%. So clearly we see evidence of that rebound we've been talking about. And there are other measures that show things are not hopeless. So for instance, in the upper left, here again is that consumer confidence survey, that same blue line I showed you before. Well, when it goes positive, it means the consumers are feeling really good about the future. And in fact, every time that blue line goes positive by those yellow circles, it shows we're on the way out of a recession. And man, did it go positive last month. So consumer confidence is indicating that. And over on the right is a small business optimism survey, both going up, the total and components. And on the lower left, the Federal Reserve has all these regional manufacturing surveys, and here's the one from New York State. Future conditions, positive and rising. General conditions, the blue line, well, they fell a record amount, they reached a record low, and now there's been a record rebound. And then finally in the lower right is the Treasury yield curve. Basically, that's a spread of interest rates shown by the blue line. And what it means is every time the blue line goes positive, it means there's a recovery. That is GDP, the brown goes positive. And the blue line is positive now, indicating a future recovery. Well, let me wrap up here really quickly. You know, even before COVID-19 came along, the economy was fragile. We had this shutdown, which led to massive losses in jobs and consumption. It looks like we've bottomed out, but again, I can't emphasize enough, it doesn't mean we're back to where we are. We're looking at 2 to 3 years before we get back to where we are. But it's not hopeless. Things are starting to look up. Now, we have lots of research like this at our website, eulerhermes.us. It's all free. Love for you to go take a look at it. And at this point, I am going to hand it back to Alex. Thanks very much, everybody.
Thanks, Dan. I appreciate it. We've got a number of questions coming in, but maybe given time, I can find one or two that might be helpful. One is, won't the enormous fiscal stimulus drive up our debt and make it uncontrollable?
Yes. Well, let me caveat that. Yeah, the fiscal stimulus, $2 trillion, that's going to drive up our debt, sure. On average, we recently have been spending something like, $4 or $5 trillion is our total budget. Throw in another 2 trillion, okay, that will drive our debt level up over the next 10 years. It's who cares? 2 trillion over, 50 trillion in expenditures over the next 10 years. That's not that big a deal. The big deal is the entitlement programs that are driving really the debt, because the entitlements of Medicare, Medicaid, Social Security, welfare, that's 2/3 of our budget, and it's expanding. And that's why we have to borrow money, so much money. That's what's really going to drive up the debt level. $2 trillion, drop in the bucket. It's the entitlement programs that are really going to cause a problem going future. But that's not a disaster either, because it's really a trade-off. It's not the end of the world. It just means the more debt we have, which we can sustain for a long time, the slower the economy is going to grow. It's a trade-off.
Great. Thank you, Dan. We've got a number of other questions, but in the interest of time, we'll address those questions after the presentation. With that, I'd like to transition the conversation to Michael Kornblau to review the trade credit implications.
Hey guys, thank you, Alex. This is Mike Trelevin, and thanks, Dan, for those timely insights. And greetings from Chicago. Thank you all for joining today. Over the next few minutes, we want to give you an overview of the features and structures of trade credit insurance to provide a background on how credit insurance can be utilized to facilitate a variety of liquidity strategies. As the product name suggests, credit insurance protects against non-payment of legal and enforceable accounts receivable, loan, or lease obligations. These obligations must be tied to trade, whether it be goods or services. For lease obligations, this generally refers to equipment or technology leases and not commercial real estate leases. In the current environment, we're not seeing much support for commercial real estate lease protection. It's available for export and domestic transactions on a single debtor or multi-debtor basis. We'll explain the differences in a moment. It can support repayment terms up to 180 days, or in some cases longer. For example, for the sale of capital goods or project finance on larger ticket items, it can be up to 1-year repayment terms, or even longer in some cases. If you think about agricultural or construction equipment or large infrastructure projects, that's typically where we see the longer terms being covered. Coverage typically attaches at the time of delivery or invoice, but pre-shipment is available for customized products. It protects against the insolvency of the buyer or a political event that prohibits the sale or delivery of that product. On the next slide, we'll describe the differences between the single debtor and multi-debtor policy structures. On the single debtor basis, it's on both types of policies. They're available for both domestic and export transactions. As you can imagine, under the single debtor, which just means one buyer, it could mean multiple sales to that buyer. The underwriting is typically a little bit more stringent. There is no spread of risk, and typically we see higher pricing on the limit basis. Some underwriters will only consider investment grade credits, but we'll also see some investment grade obligors approved on a case-by-case basis. The more common, I would say, in the market is the multi-debtor policy approach or multi-buyer approach. Again, available for both export and domestic. It's typically done on a whole turnover basis, meaning companies will protect their entire accounts receivable portfolio. Although we do see some different structures where it'll be a key account or looking at more catastrophic risk protection. The spread of risk facilitates lower premiums, as well as it helps with the likelihood of obtaining coverage on marginal or higher risk credits. There's a growing market for trade credit insurance. We've seen over the last 10 years about a doubling of the market of the participants that are writing credit insurance. They really subscribe to two different philosophies or styles of policies. The first being excess of loss, and the majority of the market writes on an excess of loss basis, and that's essentially a policy where the policyholder has a large deductible, and in exchange for that deductible, they get large amounts of discretionary authority under a discretionary credit limit. Underwriters will focus as much on the actual buyer risk as they will on the insured's credit procedures and their ability to underwrite the buyers themselves. 80% or more of those buyers in a portfolio are going to be covered under the discretionary credit limit. So the power of the pen is with the insured, and they can approve using their existing credit procedures a large portion of the credits that they're extending to their customers. The insurers will make decisions on the larger credits, and those will be named in the policies accordingly. And that coverage is typically non-cancelable. You hear a lot of talk about non-cancelable versus cancelable coverage. There are some triggers even under the non-cancelable policies that would prohibit some sales in the future if a buyer goes past due, but that's usually dictated by what's happening with the buyer on the repayment, not the insights coming from the insurance underwriters themselves. The second style is the traditional or ground up. This is more of the European style. Euler would fit into this camp. As Dan had mentioned earlier, a big part of their value is providing insights based on the large amount of information that they're able to gather. And they have millions and millions of trades that go in and a lot of information that is provided. And so a big part of their offering is not just the insurance piece, but also the information that they provide on the front end. Those policies that are written as the ground up suggest are low or no deductibles. The underwriters are going to be making more of the decisions, and the difference between the non-cancelable and the cancelable is the insurers can reduce or cancel credit limits if the information that they're gathering shows that the credit is deteriorating. With that background, I want to turn it over to Brandon Baker and Charlotte, who's going to take a deeper dive into how credit insurance can be used in the different receivable finance structures. And thank you again for your time. And Brandon, thanks for taking the deep dive.
Great, thanks, Mike, and good morning, everybody. Appreciate you joining us. So we're running a little short on time, so I am going to move pretty quickly. But to remind you, we will distribute this presentation after the call, and our team will be available to maybe chat with you online if you have questions or want to talk more about some of these topics. But what I'm going to discuss are the ways that private equity firms and their portfolio companies can use trade credit insurance to protect the balance sheet, drive organic sales and market share growth, and improve liquidity. So on this first slide, we're really just kind of focusing on the use of trade credit insurance to protect the balance sheet. Credit underwriting is always difficult, but a lot of companies out there do a pretty good job with credit underwriting, but it has its challenges. Availability of information and just kind of keeping up with changing conditions require constant diligence. And meanwhile, I think COVID-19 is a stark reminder that many risks are very difficult to underwrite, if not impossible to underwrite. Things like pandemic, catastrophic weather events, political risks such as war, cyber attack, the impact of tariffs and trade wars. All these things can potentially contribute to one of your customers not being able to pay, or perhaps even drive them into insolvency. So credit insurance is there and kind of serves to help companies even out losses year on year, bringing more predictability to bad debt, write-downs, and ultimately liquidity. And may also help a lot of companies to reduce their reserves for doubtful accounts and bad debts, therefore preserving cash on accounts. On the next slide, we're talking a little bit about trade credit insurance here as a credit risk management enhancement. So forget about the insurance protection for a moment. Mike and Dan both talked a little bit about the traditional ground up format of credit insurance. Dan mentioned that Euler Hermes, the largest credit insurer in the world, has a database of $85 million companies. I believe I've heard Euler say that they might underwrite something like 30 to 40,000 credit limits a week for their global client base. So they are, in many respects, like an underwriting factory. And insurers like Euler and others, they're buying information from third-party credit agencies. They're being fed payment information from their customers. They're getting financial statements on a lot of these buyers, either from their customers or directly from some of the buyer companies. So they just have these really large databases with a lot of information that allows them to make very informed credit decisions, and they have large underwriting staffs who also just are constantly monitoring and reviewing updated information in real time as it comes in, so that they're able to make really good credit decisions. So a lot of companies are using credit insurance, really looking at it as a credit management tool, just like they'd look at credit information reports, say from a Dun & Bradstreet or letters of credit, or other tools that are out there. And a lot of companies who are using trade credit insurance to cover their entire business, you might find that allows you to reduce your credit information spend. And a lot of these insurers also will work on collections if there is a default, both before they pay you a claim and after they pay you a claim. So a lot of companies may be able to offset the cost of insurance by reducing costs that they might otherwise be spending on third-party collections. And I think a lot of our clients are going to benefit from this underwriting feature as business and the economy hopefully starts to resume to normal. A lot of companies aren't going to survive COVID-19. Some of them are going to be hurt pretty bad by it. So, the companies using, credit insurance are, I think, going to have a lot of information available to them through partnership with their underwriter to really figure out, which companies are credit worthy coming out of this as well. Moving on to the next slide, just talking a little bit about the use of trade credit insurance to drive sales and market share growth. Credit insurers are there are some markets that are not doing well. Venezuela maybe is one example where by and large credit insurers are not able to offer coverage, but generally they're pretty open in most countries around the world, including Brazil, Russia, India, China, and other emerging markets where a lot of companies see a lot of growth potential. And today we're talking about trade credit insurance, which generally covers short-term repayment. So for non-capital goods or services, the maximum repayment terms that the insurers cover are 180 days open account, and then the maximum terms for capital equipment sales or perhaps project finance are up to 1 year repayment. So, one of the key questions we ask is, can extending these maximum terms allow your company to sell more? And, I've been doing this for about 22 years, and I've asked that question of companies, I don't know, probably a few thousand times. And you get a pretty common response from different people that you pose that question to. So if you ask a salesperson if extending 180-day terms will help them sell more, 9 times out of 10, they're going to say, absolutely, yes, this will drive a lot of sales growth for our company. If you ask a credit manager, a lot of times he or she will say, yeah, it might help us sell more, but I'm not sure if I'm able to approve the kind of credit limits that we need for a lot of these customers to support those repayment terms. And then if you ask maybe a treasurer or CFO, a lot of times they're going to agree both with, sales and credit. But meanwhile, say, extending long terms like that really isn't viable, given the impacts to liquidity that would have. We just don't think that we could manage, the extension of 180-day terms from a liquidity and cash flow standpoint. So that kind of takes us into the next slide, where we talk about the use of trade credit insurance in tandem with bank AR purchase facilities. So the idea here is that a lot of the banks out there, financial institutions out there, have AR purchase programs where they are able to make a purchase of the receivable off your balance sheet that meets FASB true sale guidelines. And so once these programs are set up, it allows you to make the sale of the receivable to the bank, non-recourse or with limited recourse, and you can sell those receivables monthly, weekly, or perhaps even daily, depending on what your needs are. So, a lot of the companies that use these programs, it really opens the door up for them to offer these longer terms. Because if you're offering 180-day terms and then sell that receivable, your DSO is going down to the number of days between you raise the invoice and sell it. You're monetizing the AR asset and getting cash right away without having to wait for the invoice to mature. And a lot of companies using these programs actually find that they're able to pass these financing costs, the cost to sell the receivable, and the credit insurance costs on to the customer. So you consider Brazil for just a moment, where local interest rates still tend to be in the double digits. If you're able to offer 120 or maybe 180-day terms, or even one-year terms, if you're selling capital equipment to a customer in Brazil with an all-in cost of LIBOR plus a few basis points, they're likely going to take it. If you're saying, look, we'll give you our standard terms of net 60 for no charge, but if you'd like to have 180 days at, say, LIBOR plus 3.5, 4, whatever it may be, I think a lot of times they're going to accept it. So it sort of presents a win-win for all parties. And I think even for customers that have comparable financing costs, may still take you up on the offer to absorb that cost, because you're essentially providing them another fairly large credit line at attractive rates above and beyond what they're getting from their own lenders. Going to the next slide, again, we're running real short on time, so I'll just quickly tick through some of the key benefits. So again, selling receivables allows you to improve liquidity, free cash flow, days sales outstanding, allows you to make a non-recourse sale of the AR, so you're essentially transferring the credit risk to the bank when you make the sale of the receivable. With the banks that offer these programs, they usually will essentially hire you back to manage the receivable after they purchase it. So there's really no disruption in your day-to-day interaction with the customers. You don't have a third party getting between you and your customer relationship. And again, the program, generally can potentially help you drive revenue growth through the extension of longer terms and allow you to pass those costs on to the customer in exchange for those longer terms. The next slide just touches on some of the key features. Again, just kind of moving quickly here, you've got to be able to assure that the AR being sold is free and clear of any liens and it's assignable to the bank. Limited recourse. Generally, the banks are typically going to have you indemnify them for any uninsured amounts, which might be 10 to 5% based on the co-insurance of the credit insurance. And I think, the rest you can take a look at outside of this call. The last point really is just using insurance to maximize borrowing under ABL facilities. So bottom line is, if you put an insurance wrap on your receivables, it can allow you to borrow a lot more through your ABL credit facility. That may allow you to include foreign receivables, obtain higher advance rates on AR, loosen concentration caps that may be imposed on large customer AR, and perhaps even reduce rates or fees because of the credit enhancement that the insurance provides. And finally, the last point, for the private equity companies that own a fair number of companies, it may not make a lot of sense that, companies that you own in different industries be insured under one policy, but you still have the opportunity to potentially negotiate insurance collectively for all your businesses, which creates a spread of risk and more sales volume to help you sort of collectively get lower premium rates for your companies who use trade credit insurance. So that's it for me. We did have a couple of case studies for you, just two that we wanted to review, but it looks like we're short on time. So again, you can have a look at those case studies once we distribute the presentation. And again, we're here to answer any questions for you either now or outside of this call. So thanks very much, and back to you, Alex.
Great. Thanks, Brandon. A couple of questions here just coming in. Might try to take the opportunity to answer one or two just before we close out. One question is, do unforeseen credit losses also include losses due to global pandemics? Michael Kornblau, do you want to address that?
Yeah, thanks, Alex. So quite simply, the answer is absolutely yes. This is a comprehensive credit product. It picks up all risks, and the pandemic losses would not be the proximate cause of loss, but rather it's the credit event which will be the proximate cause of loss. So things like that are, in almost all circumstances, not excluded from coverage. So it would be generally an approved form of cover, and exactly what the policy is intended to address.
Great, thank you. And maybe one more we can sneak in. How would you compare trade credit insurance to other risk transfer options, such as credit default swaps?
So I can take that one as well, Alex. So there's a great deal of difference. The credit default swap is a highly used product, but it's limited in its application insofar as generally the risks that they take for those products are generally companies that have publicly traded debt, whereas the credit insurance product covers millions and millions of obligors, and a lot of the risks that they cover end up being private companies in which there's no publicly traded debt, in many cases not even financial statements which are provided to the insurance company. So the universe of debt where CDS would cover perhaps thousands of names, we are looking probably at about 100 million names that get covered through the credit insurance markets. And I would say the last point too is the pricing can change between the CDS and the insurance product, but generally the insurance market pricing has been much more stable than the CDS, where the CDS can react fairly violently to events such as COVID-19. There is, I think, a more mature and more stable pricing rationale under the insurance market schemes. Thanks, Alex.
Great. Thank you, Michael. In conclusion, that's all the time we have today. If we didn't get to your question, someone will get back to you, or if you prefer, you can email any questions about today's presentation to questions@marsh.com, and someone will reply after the webcast. I'd like to thank our panelists for participating in today's discussion, and we again thank all of you for joining us during what we know is a busy time. Thank you for joining, and look forward to speaking.